Hello everyone. The market started the week in a risk-off mood after China's GDP growth unexpectedly slowed in the first quarter and the pace of growth in industrial production dropped in March. The news sent the dollar and the yen higher on safe haven demand, while commodities and the commodity currencies fell particularly sharply. The big event this week will be the G20 central bankers and finance ministers meeting in Washington at the end of the week. They'll probably try to criticize Japan for its foreign exchange policy as usual. Even the U.S. Treasury, in its biannual currency report to Congress, said that it will press Japan, quote, to refrain from competitive devaluation and targeting its exchange rate for competitive purposes, unquote. Now, several U.S. officials, including Fed Chairman Bernanke, have tried to explain that monetary policies meant to target domestic conditions also have an impact on the FX market. For example, the U.S. quantitative easing program has had a dramatic effect on the dollar, but nobody mentions that. The fact is that the dollars the Fed is printing in its quantitative easing program are going overwhelmingly to foreign banks, which then sell the dollars to provide funds to invest in their home bond markets. So the Fed's monetary policy is one of the major factors supporting the euro, or looked at another way, depressing the dollar. But let's not mention that because that would be rude. In any event, some temporary retracement in dollar-yen would not be surprising under such circumstances. Ahead of the G20 meeting, it looks like we're set for a continuation pattern, similar to the one-month consolidation period we had back in March 2009, before dollar-yen temporarily pushed over 100. Some support looks to come in at 97.20, with 98.30 and 98.90 acting as resistance levels. After the G20 meeting, I'd expect dollar-yen to gradually resume its assault on 100. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.